Good afternoon. This is Zachary Bauk, Chief Investment Officer of Denver Wealth Management. I'm here with Managing Principal Blair Braden. This has been a crazy 7 days in the stock market. Last Wednesday, we were at an all-time high in the Dow Jones, the S&P, and the NASDAQ. Just 7 days later, we've lost 10 to 15%, depending on where Friday ends. We're recording this right now, Friday right at noon, so there's 2 hours left in the market. But we wanted to make sure we got a message out to our clients in a very timely manner. It's hard to call 400 different people, and we wanted to make sure we had a chance to communicate with you what's been happening in the stock market, what common mistakes people make, and then last of all, what we're doing to protect your income and to protect your assets. So Blair, what's gone on these last couple days here?
So as you probably know, the coronavirus outbreak started in China somewhere around mid-December. It's expedited and started to spread. And, China itself had about 50 million people quarantined in China as it was trying to contain it. However, coronavirus keeps spreading similar to some of the other viruses in the past. However, some key differences being that, coronavirus seems to have a much higher contagion rate than a lot of the other viruses, but a lot lower mortality rate than a lot of viruses. And so one positive, I think, as we compare this virus to some of the others, is that how quickly the drug companies have been getting vaccines put together and approved, and well, not approved yet, but at least in medical trials. So if we compare that to Ebola, one of the most recent big outbreaks that we had, that took about 20 months for the vaccine to get to trials and to be tested and then start distribution. We're, call it 2.5 months in, and already drug companies have the vaccine into the clinical trials. So, I think that's a big positive, but we've seen that really pull markets back, and it's for several different reasons. One, we think the majority of that reason, be it fear and emotion. However, maybe some legitimacy in that people are concerned about the supply chain issues and possible global slowdown, mainly because some of these quarantines that have happened. And that is different than some of the viruses in the past as far as how many quarantines have taken place. So we've seen the market be very, very volatile in the last 7 days. There were days when the market started very positive and still ended negative. On Wednesday of this week, I believe it was, we saw a lot of activity in the forward futures contract of the S&P 500. And before that happened, and I'll explain that a little bit, the market was down about 1,000 points on the Dow that day. And then we saw a lot of activity of people buying these futures contracts. In layman's terms, that's just people putting their money in a place where they expect the puck to be going, or the market to be moving. They are predicting that by June of this summer, the market would be back rip-roaring, back to normal type of stuff. And so we saw a lot of money flooding in. That Dow Jones, again, it started the day about negative 1,000. When we saw those futures contracts coming in, the Dow was gaining steam, and it was looking like it was going to turn positive, down about 200 points. And then at that point in time, California came out and said that they were testing 8,400 people for coronavirus, and the market fell again. And so as news has continued to come out about the coronavirus, the market has been acting, very volatile to the downside, thus losing somewhere between 10 and 15% rather, depending on today, from its all-time highs a week ago.
Yeah, so it's been a rough 10 days. It really has been, and it's been painful if you've been looking at your account. And the common mistakes that we see people make in these times, the first mistake is that they want to sell their investments and move to cash. That is just a strategy that even if you time it right, like let's say you moved everything to cash last Tuesday, very few people then have the courage to go ahead and put the money in when the market's down, because you don't know if you should put the money in when it's 5% or 10% or 15%. What if it goes down to 25%? People who manage, it's very hard to move your money out of the market before it crashes. And if by some miracle you time it exactly right, those people never get the money back in at the bottom. So that's the biggest mistake we see people make, is they always want to move their investments to cash in hopes that they can move away from these downturns, but it just doesn't work. So that's the biggest thing you can avoid doing. The second thing that you can do is, I've been happy to have clients calling in and say, hey, we have more money. We can invest right now. We've got an extra 5,000 here. Let's fund our Roth IRAs. This is a time where we were just at the Forbes Top Advisor Conference in Las Vegas, and we got a chance to meet with legendary investor Bill Miller. And Bill Miller he's a multi-billionaire now, runs a hedge fund, and he was on stage and he said, I've trained myself over the last 30 years that whenever the stock market is red, I see that as a buying opportunity. And these last 7 days, even though it's been brutal and it sucks to see the market go down so consistently, if you can train your mind to see red as a buying opportunity, you are going to get a much better return than most investors. And that's what myself and Blair have been doing. We're seeing red as a buying opportunity.
And with that being said, absolutely, I agree with that. For our long-term investors that have the goals that are down the road here, not tomorrow, but for the goals that are down the road, I agree 100% that now is a buying opportunity. Everything's on sale 10 to 15% cheaper than it was this time a week ago. And so, but we also have to check our objective. What's our goal with this money? What are we looking to have as the outcome? If we're trying to buy a house or a car or, some purchase in the next few months, a year even, yeah, probably not a good time to rush out and buy stocks. That money really should not be in stocks. That money needs to be more safe and secure. But for our clients who are in the accumulation phase, so they're younger and they're putting money in, absolutely a great time to be buying right now. But let's switch gears a little bit and talk about our clients who are in the income stage of their progression with their wealth. So they're pulling money out of their accounts. What do we say to them right now?
There's two big opportunities right now. So you don't ever do something out of fear. You don't say, oh my gosh, the coronavirus is scary, let's sell these investments. But these unsettling markets, they create opportunities. And there's also some legitimate concerns about business and economic performance, because when we buy investments, I always think of it as actually buying a business. If we buy it through a mutual fund or an ETF, we're still buying an underlying business that has an outlook, has future cash flows. There really is no question at this point that international markets are going to suffer, I don't know, it depends on how you want to say long term, but international markets are going to suffer because a lot of the supply chain in China and now Italy and Iran is starting to get gummed up. So we don't know if that supply chain disruption is going to last 3 months, 6 months, or 9 months, but it's not necessarily a place we want to have a lot of our money if we know that 9 months down the road, they're still going to be in very difficult spots. So one of the things that we're taking action on today is we're reducing our international investments and buying some of the investments that have gone on sale in the US. So we're selling international in places that are going to be long-term affected and buying investments in the US where we think we're getting a ridiculously good value.
And it also goes to the reason why we've talked to all of you in that stage of life of income, of why it's important to maintain balance in your portfolio and to not have all your eggs in any one basket. And so, as most of you probably know, you own different types of assets. As a part of our process, when we're analyzing, do we buy in this investment or that investment, there's certain variables that we're looking at. One is what's called its upside downside capture ratio. So we'd like to buy assets that perform good in the good times and don't perform as bad in the bad times. As we've been checking our investments over the last week, I'm proud to say that the majority of our assets have been working well to that. And specifically in this type of portfolio for people who are pulling money out, that our downside capture in a lot of our assets aren't as great as their corresponding, counterparts that could be out there. So that's one point. But also, it's the idea that stocks and bonds act differently in normal market conditions, and we've absolutely been seeing that happen today. So a growth with income type portfolio, which a lot of you have, typically is going to have somewhere around 70 to 60% stocks, the other 30 to 40% bonds. And that those bonds, they hurt us last year, right? I mean, they still made pretty good money for bonds, but comparable to the stocks, they didn't make us near as much. We own those for times like this right here. And that, as the stock market has been depressing and coming down, we've seen the bond market actually rally and rise. And so we have assets in those growth with income type of accounts that have actually appreciated through this time period. So you call us up and you need some money out of your account. Again, we like to sell when it's green, not when it's red. And so what we're going to do is look at the account, notice our bonds have rallied, and that's where we're going to be liquidating from to be able to fulfill your cash needs that you need, so that we can allow our riskier growth type assets, the stocks, to be volatile. Give them the time they need to come back. Historically, these virus outbreaks have been very short-lived. They've rebounded, just without the virus even. When the market pulls back, on average 11% per year from peak to trough, usually it takes about 4 months for that money to come back. If we're able to not touch our risky assets, the stocks, during that time period, the thought process, which has historically worked, is that it gives it the time to allow those assets to come back up, reappreciate, and then, once a year, we rebalance the portfolio so that we get it back into that balance that we're looking for, to make sure we have the right amount of risky assets and the right amount of conservative assets based on our clients' objectives and needs as far as how much money that they need out of the accounts. And so, yes, the screen, when you turn on the news this weekend, it's going to be flashing all over the place how dire things are in the stock market. And for the last 7 days, that's absolutely correct, and it's true. But remember, for those types of clients, not all your money is tied to the stock market. You have money in other places, you're balanced, so that it gives us that opportunity to still satisfy income needs without taking a loss.
So I think the question on a lot of people's minds is, where do we go from here? So the market's down about 13%. Is this 2008 financial crisis where the market's going to go down 50% from the top, or are we going to get a quick 4-month rebound? The truth is, your guess is as good as mine. We don't know. No one knows what's going to happen. And just to give you an idea of that uncertainty, like Blair mentioned, we have multiple coronavirus vaccines in stage 1 trials. They could come out tomorrow, Saturday morning, and say, great news, everybody, we've solved it. We're done. And the market would probably rebound fast, very quickly. Or, you could see California get quarantined, and now Nevada's quarantined, and now Utah's quarantined, and all of a sudden the whole US economy is slowing down, not just the international economy. So really there's no way to predict exactly what's going to happen, and people who think they can are more likely to make bad decisions than people who just accept that they can't. So in light of that, we are taking the action of selling investments in the places we know are going to be affected the most and buying investments that have gone on sale. And other than that, we're just going to continue to monitor the situation. We have an investment process where the first Tuesday of every month, all the advisors get together and we talk about our portfolio process. We talk about the macro outlook. We'll talk about the coronavirus, and we'll make decisions as a team as the best way to move forward.
Yeah, and something on that point too, talking about the risk of seeing our accounts go down in value, and that's what is the apparent risk today, and the idea that we need to become more conservative and hurry up and switch our accounts to something more like cash or bonds, more so than we have currently. Another underlying possible risk is if what the second scenario Zach just mentioned, that if this virus continues to spread and worsen and more quarantines come into play, one action that I believe we think is a very possible reaction to that is the central banks around the world infusing cash into the economies to help prop things up. Well, if that happens, a very possible risk of something like that is inflation. And so for our folks who are pulling income out of their accounts, that's always going to be a risk for us is inflation, and the ability to maintain your lifestyle throughout the remainder of your retirement. And one way to best approach inflation and fight that risk is by owning the stocks. And so, it's kind of going back to physics. Every action has an equal and opposite reaction, right? And so, if this happens, the quarantines, now inflation, or now stimulus comes back in, now inflation rises, those are risks that are also present and out there. And so going back to making drastic moves one way or the other can be a giant mistake because of some of these underlying risks that are out there. And so, and one other action that we've been taking action on now in order to try to take advantage of this scenario as much as possible is, again, it depends on what type of account class you have and the objective of those accounts. But in our non-retirement accounts, we've been taking advantage of what's called tax loss harvesting. Long story short, what that means is, hey, there's lots of assets out there that have similar characteristics. Right now, a lot of the markets are down. And so if we own this ETF or let's say we own this mutual fund and it has a loss because of current market conditions, well, there's probably a corresponding ETF out there that looks and feels pretty similar to this mutual fund. So let's sell this mutual fund, capture that loss, take the proceeds, buy this ETF over here so that when things rebound, we still get the rebound. But because we've made that transaction, we have that loss on our books that you guys can either use to offset your gains in your portfolio throughout the year, or we're all allowed to use $3,000 per year of those capital losses to offset our income. And so, is there an income tax or is there a tax strategy here with this market pullback? And we think, yeah, there's a possibility to save some money on taxes here through this. And so that's another action that we've been taking. And so, you might have some trade confirmations come through, specifically if you have some of those non-retirement accounts and maybe you have some losses on some positions, and if that loss is substantial enough. So
the last thing I'll say here before we bid you a good weekend is a lot of people right now are nervous and they're freaking out and they're trying to sell, and we're getting a lot of phone calls. Not that many, but we're getting a few phone calls of people saying, what should we do next? If you have a friend, a family member, a coworker, anyone who isn't sure what to do, we know what to do. We're not panicking because of what the market is doing. We're looking for opportunities. We're looking for investment sectors that will be negatively affected, and we're taking advantage of this situation. So please feel free to share this video and share our information with them as well.
Yeah, and of course, if you want to chat with us, we're always happy to do that. We just wanted to make sure we got something out there to everybody so that you could hear our thoughts in case you don't have time to call us or we're in a meeting when you call, whatever it may be. And one thing to remember through all this, again, we think that a lot of this very emotional right now. This market, the way it's acting right now, is very emotional. What does Warren Buffett, who, if you don't know, pretty good investor out there, what does he say when people are fearful?
Be fearful when others are greedy, and be greedy when others are fearful.
And right now, fear is high. And so again, we've gotten way more phone calls this week of people wanting to put more money into the market than we have of people wanting to pull money out of the market, which I have to commend so highly all of our clients who have done that. Finance, your wealth journey, so much is based on your behavior with investing, not necessarily which assets you pick all the time. It's more your behavior a lot of times. And so we've seen some wonderful behavioral finance activities this week with our clients who are investing more funds during this time period. And again, that's not right for everybody. I'm not saying everybody needs to rush out and go buy the stock market right now. But for a lot of people, it makes a lot of sense. And so if you're questioning that, you have concerns, questions in general, please reach out to us. Let us know. We're happy to answer those. So thank you all very much for your time. And I'll copy what Zach said. Have a wonderful weekend. Try not to let this get under your skin too much. This too will pass. It always has since 1926 when the market became the efficient market it is today. And so again, stay pat, stay the course, pay off your consumer debt, make sure you have 3 to 6 months of emergency fund in cash, some of the basics, and then let us know what questions you have. Thank you very much.